So William is a case study style question. That's what the examiner calls them, where he tests us across a broad range of topics. So normally in question 2 and question 3 of the exam, this is broadly the style you can expect to see. We're going to advise William. So let's personalize it to William. From accountant, subject, advice on accounting treatment. I'm conscious of the fact that I'm trying to pick up those 2 professional style marks. So the first item, it's in respect of the building. The transaction is classified as a sale and finance leaseback because, and by now you're learning that I want to use the word because as often as I can. It's going to force the whats into whys. Why is that the case? Because, firstly, the lease period is equivalent to the majority of the asset remaining life. And secondly, the present value of the lease rentals is the same as the sale proceeds. Keep your answers short, direct, and to the point. So at the sale date, the profit on disposal of the building is deferred and spread over the lease term. So what I'm going to do here is I'm going to debit cash I'm going to debit cash 5 million, credit PPE 3.5 million, and credit deferred income 1.5 million. We then recognize a financial asset and liability for the lease. So we're going to debit PPE, leased asset, 5 million and credit a lease obligation. £5 million. The building will be depreciated over the shorter of the asset life and the lease period, which is 20 years. When did we take out the lease? We took out the lease on the 1st of June X2. So therefore, debit the income statement with a depreciation expense of 5 million over 20 years, which is 250,000, and credit PPE 250,000. So it looks like the company is going to lose out because the company used to depreciate the asset far less than that. But we also release the deferred income. Over the lease period. Credit income statement. How much was the deferred income? 1.5 spread over 20 years. So that's going to be 75,000. And we debit deferred income 75,000 as well. So you see what I'm trying to do is to break the question down into smaller and smaller parts and deal with each of those in turn. The finance charge and lease obligation is calculated using the amortized cost model. So what are we going to do? Well, date 1st of June X2. How much have we borrowed? We've established that our financial liability is 5 million. Repayments are at the end of each year, so we're going to calculate interest. Interest is going to be 7%. We're told that in the question, which is 350. We repay 441,000. Which means that we have a liability at the end of the year of 4909. We need to do the calculations for X3 as well. Oops, sorry, it's not 350, is it? So in year 2, our interest charge falls to 344. So in the income statement, there's an interest expense of 350k in the SFP. We have a non-current liability, 4812, and a current liability, 4909 less 4812. So our total lease liability, 4909. So I've dealt with every single element within the question. I'm looking all the time. It's 7 marks. I think I've got at least 7 marks there. We've covered every aspect, and we've done it in 11 minutes. 11 minutes is around about. You actually have 12 minutes to do that. Next, we've got item B. So we've got our pension plan. Shortly before the year end, we decided to relocate a division from one country to another. The relocation is due to take place in December X3. So pension plan and relocation should really be our heading. So we look at the information, and the key decision that we need to make is, should we or should we not create a provision? A provision should be created for the relocation because, first of all, a constructive obligation has been created when William informed the employees on the 14th of May. The obligation was created before the year end. Remember, under the standard, it is an obligation existing due to a past event. The key event is William telling the employees that you're going to be relocated to another country. The decision appears to be irreversible. Secondly, an economic outflow i.e. an expense is probable. And thirdly, a reliable estimate $50 million has been calculated. It says half of the affected division's employees will be made redundant in X3. So can you see the cost? In theory, William could discount the cost the $50 million cost. But because the redundancy is so soon after the year end, this is immaterial. So the accounting adjustment is debit income statement 50 million, credit provision 50 million. And if you want to do another mark, you could equally say that if this is material, there's a case for disclosing it separately on the face of the income statement. I don't think we're told how much Williams' profits are, so therefore working out materiality is more complicated. But you could certainly add another mark, another comment in respect to materiality. So that's dealing with the provision itself. As far as the pension is concerned, the redundancy is a curtailment of the pension per IFRS. You don't need to remember the numbers of standards. Just say it's a curtailment. It should be recognized immediately in the financial statements. So what does it say here? It's a net reduction in the pension liability. So if I'm going to reduce a liability, I'm going to debit pension liability $15 million and credit the income statement $15 million. Again, there is a case for saying that if 15 million is material, show this separately on the face of the income statement. That's down to you. That's sort of a bit of a nerd point. So we've dealt with both issues. You don't have to write huge amounts, but what I've tried to do is to ensure that all of my comments are focused on the issue. Don't want any wasted words. Next, we've got share appreciation rights. Now, look at the dates very, very carefully. Our year end is the 31st of May, X3. This scheme started on the 1st of June, X2. The intrinsic value should form the basis of the liability at the end of each year. The grant date of the scheme was the 1st of June, X0. and the vesting period is 2 years. At the end of the previous accounting period, because remember we're preparing the accounts for X3, so that's going to be at the 31st of May X2. The liability was, well, it's going to be 500 share appreciation rights to each of 20 managers. It was thought that 3 managers would leave over the initial 2-year period, and they did so. So it's going to be 20 less the 3 who left, so it's going to be for 17 employees. The fair value at the 31st of May X2 is $14 each. And we're at the end of the vesting period. With 2 years through a 2-year vesting period. So it's 119,000. So what you might want to do, because this question is a little bit unusual, you might want to open up a ledger account, a little T account. Share appreciation rights. At the start of the year, our liability is 119,000. It then says, on the 31st of May X3, 7 managers exercised their rights when the intrinsic value of the right was $21. So at the 31st of May X3, some managers cashed in their rights and how much is that going to cost the company? Well, the company's going to have to go, or William's going to have to go, credit cash. It's 500 rights for 7 managers, and the intrinsic value at that date was $21. So that gives us 73.5 thousand. And we will debit the share appreciation rights account 73.5. The remaining rights can still be exercised at a later date, and if we look at the question, it says, well, they have a value of $24 each, because we think the share price is perhaps going to go up again, giving a total liability of 500 options. We did have 17 managers who qualify, but 7 of them have cashed in, times $24 gives us a grand total of $120,000. So my year-end balance, this figure, appears in liabilities. So that's going to be my carry down figure in the statement of financial position. Which leaves me with a balancing figure of 74,500, which is our income statement expense. So the balance of 74,500 is charged to the income statement. Dates are important, breaking down the questions is important, clearly knowledge is important as well. Then we've got the issue in respect of Chrissy. William acquired Chrissy on the 1st of May X3, so it's during the year. At the time of the acquisition, Chrissy was being sued as there's an alleged mis-selling. The claimants are suing for damages of 10 million. William estimates the fair value of that sum is 4 million and feels that it is more likely than not that no outflow will be incurred. So we don't think we're going to have to pay it out. William wishes to know how to account for this in Chrissy's financial statements and also the consolidated financial statements. As soon as I see the word "and" in any part of the requirement, I know that there's 2 requirements. So I'm going to deal with each of those in turn. So let's take a look at the books of Chrissy. This is a contingent liability because it's a possible obligation it's due to a past event which was the mis-selling. And the outcome is dependent upon an uncertain future event What is that uncertain future event? It's the court ruling. And a reliable estimate can be made. Because an outflow of funds is unlikely, see, it says here that it is more likely than not that no outflow of funds will occur. I think the wording is a little bit messy, but because an outflow of funds is unlikely, we would disclose in the notes of Chrissy a contingent liability of 10 million. We've then got the consolidated accounts of William, per IFRS 3, we should include contingent liabilities in the group statement of financial position at their fair value. So therefore, we should create a liability of $4 million in the group at SFP this will decrease net assets and increase the goodwill of Chrissy by 4 million. So can you see I've identified and I've addressed both parts of the question.